Well, tēnā koutou katoa, and in the spirit of keeping things consistent, good morning. Good morning, everyone, and welcome to our monetary policy statement. You've obviously all had a chance to read and semi-digest, but I'll just make a few comments at the beginning to help the process. First, very much as widely anticipated, we have left the official cash rate on hold at 1.75%. Also, as largely anticipated, we expect to keep it low, but for longer. So that is really, I would say, the information space that we provide you today. We also believe that the next move for the OCR could be either up or down, but we see the risks very much as balanced, and we can talk about those risks today. Recent economic growth has moderated. We were trucking along above 4% per annum in 2016. The most recent print has us below 3% at 2.7% growth. So that moderation has meant that there is more room for monetary stimulus for longer, and that is what we are providing. Looking ahead, we do anticipate economic growth to pick up. There are many reasons for this, for the environment to be conducive to stronger economic growth. The first, of course, is world economic activity remains robust. World economic growth is well north of 3% per annum, and it has very strong momentum on the way through. Of course, that world growth is mixed depending where you are. US economic growth, very strong. Europe growth is picking up, and Chinese economic growth has showed signs of stimulus coming back through. Another big area of excitement for us, of course, is the New Zealand dollar exchange rate has been lower. So we do see our net export earnings being stronger and profitability in that sector coming back. The government is also implementing a significant spend and investment program over the next 3 years, and that will have a significant command on our economic resources, both capital and people. And likewise, of course, this is sitting on top of a bed of what I would say is reasonably robust residential construction growth, given the housing needs, and ongoing household spending. Although nominal wages have been low, they have been rising faster than inflation, so there is money in the pockets there. Through this growth pickup that we anticipate, we expect employment to remain strong. We do see ourselves as being broadly near this concept of maximum sustainable employment. So really new demand for labour is being met with labour supply. We do see unemployment easing, declining, I should say, from here to around the low 4% over the forecast period. Of course, there are many, many uncertainties around what is a maximum sustainable employment level, and we are operating primarily in the cyclical demand side of things. We forecast inflation to continue to pick up from where it is and to be at the midpoint of our 1 to 3% inflation band over the forecast period. I'd have to say we have been positively surprised with some tentative signs of core inflation picking up. We've sat here many times with forecasts of inflation going back to the midpoint. We have been continuously surprised by how low world tradable prices have been, i.e. our import prices, and also how muted, probably at least forward, if not a little bit backward-looking inflation expectations from the public, holding down our overall inflation. But times are changing. We are seeing global inflation pressures starting to rise, so that downward pressure from import prices is waning, and we will see our tradables, our domestic inflation, remaining around that 2.5 to 3% rate over the forecasts. There will be some bumps along the road, of course, on the inflation path at least. There are some one-off price increases that we're well aware of arising. One, of course, is from the lower exchange rate and hence import prices. We've had higher world oil prices that we expect to remain at relatively elevated levels in the forecast. And there are the petrol excise tax plans being implemented over the next, in stages over the next couple of years as per our forecasts. There's all one-off price bumps, we intend to look through those. We intend to remain vigilant, looking for, I would say, inflation momentum and rising inflation expectations before we react to that. What are the risks? Well, as I mentioned before, we believe they are balanced, hence the up or down next move on the OCR. It's interesting, given that we are in a low and stimulatory position at the starting point. That gives us comfort, given where actual inflation is relative to target. In terms of upside risk to the official cash rate, inflation and inflation expectations could get away quicker than what we project. The challenge there, we are seeing margin pressures in businesses that could be passed on into higher prices where they are able to, and the higher prices could lead to higher inflation expectations and wage demand and so on than what we have in our forecasts. Likewise, on the downside, we're well aware of business confidence levels being low. As we've talked about in our document, we spend more time focusing on what I would say firms' own activity and investment intentions. They've also declined somewhat over recent periods. Hence, we do have a more muted investment cycle projected, but our growth could take longer to pick up than what we project through that side. So we're comfortable where we are. We will do what central banks do best, which is watch, worry and wait. And in the meantime, the OCR remains where it is. So thank you for listening, and I'm happy to attempt to answer questions. Just before we go there, I do want to introduce Jeff Bascan, our Deputy Governor, and John McDermott, our Chief Economist and Assistant Governor, and I hope that I can deflect the tough questions to them. Thank you.
Morning, Governor. This morning's OCR forecast is quite a lot different to the track you were projecting back in May's MPS, and I was wondering if you could walk us through the rationale behind your thinking as to what changed between May's MPS and today's in terms of that OCR track.
Yeah, so the main difference is certainly not the level. The last time we said it's going to stay low at its stimulatory level for a long period of time, and the risks could be up or down. So nothing has actually changed there. The difference is that we see it as being lower for longer. Of course, out in that horizon, the further afield, the more uncertain. But the lower for longer comes from a couple of factors, really. One has been the recent slower actual economic growth, which gives us, more confidence that there is not immediate capacity pressure leading to the rising inflation. The other area has been very much around, the risks, the balance of risks, I would say, have become very even on the way through, about up or down, and so we are just in no rush to be moving. One of the great mysteries that are out there, and one which we have firmly anchored in our projections, is that inflation expectations have been incredibly low and based on current observed inflation as opposed to future expected inflation. So that's embedded in that forecast as well.
Governor, you've mentioned that rates could either go up or down. Why then do we have the forecast that it will go up at the end? Why not just have a flat line?
Yeah, I would say it's within the bounds of uncertainty of forecasting. Really what we're saying is that if things evolve, then at some point in the future, given that we are currently in a stimulatory position, we would be wanting to move back towards a more neutral interest rate position. I think it would be a straight line if we were kicking off exactly at neutral now and all risks were balanced. Wonderful.
Go again if nobody else wants to. Just in terms of where you perceive GDP growth and economic growth to be in the future, I note that both the government's fiscal stimulation is, and you've noted this in the MPS, is looking to bring a lot more on board. And now with this new OCR track, you're keeping it lower for longer, which would imply more monetary stimulus as well. Is this kind of your answer to help keeping the economy humming along and working with the government while they have this fiscal stimulus and you have this monetary stimulus?
We set our monetary policy based on what we observe and what a government's intentions are. And so really the official cash rate setting is based on how we see the economy evolving, and part of that evolution is government's investment intentions. So it's having taken on board that behaviour. So that's right. I would want to emphasise that the government investment is one part of the equation, and it's a big known part in the extent that it is completely endogenous within their control to do this work. The risks we put around it is can they spend as quickly as anticipated? Will we see as much stimulus as what's in there? But I do want to emphasise that part of the growth story is very much about a transition around net export growth being much stronger, given where the terms of trade are, given where the exchange rate level is, and given where world growth is holding up. So that is a net export, a transitional change for the growth drivers of New Zealand. Likewise for business investment, the great unknown, business investment, given the capacity constraints that are out there in the economy, given the tightness in the labour market, and given that global demand, all signals are green for business investment. But there is uncertainty in businesses' minds at the moment, and we're cognisant of that. Hence, we have kind of tempered, I would say, our growth for investment.
You mentioned you mentioned quite far up your MPS that business confidence surveys have weighted quite heavily on this decision. I was wondering if you could perhaps speak a bit more as to how much they were weighted into this decision as opposed to your last MPS.
Yeah, I would say all indicators we can get are weighed as heavily as we can, because this is the inexact art as opposed to science of trying to project what is going to happen. What we see with business surveys, very often at best they are coincident, i.e. you are looking out the window, what do I see today, that's how I feel. And so that's where we are not surprised to have seen some decline in business own activity indicators. We don't have reasons for the absolute level of the business confidence decline we've seen. That's in the minds and hands of the people who fill the surveys in. But for own activity, that is probably the best coincident indicator we can have, as well as investment intentions. And so both of those have come off, and that gives us more confidence around our near-term projections of investment, of employment demand, the actions. None of them are very good at forward-looking beyond effectively the here and now. Would that be fair, John?
Yeah, maybe one technical point to add. There's a range of questions you can answer when you're answering these business confidence surveys. We tend to ignore the headline number that gets reported in some newspapers and so on. And we really do focus on, the question is, what is your business doing? How do you feel about your business? Because business leaders tend to know about their business and they have that information. And that tends to be well correlated with the general economy.
You're forecasting that house price inflation is going to stay around about these levels over the next few years. You're saying Kiwi build is going to be slower or have a lesser impact. The pressures on the other way, pushing prices up, haven't gone away. So why are you so confident you'll be able to keep a lid on it?
Yeah, we're confident, our core forecast, you're correct, Jenny, that we have, we've actually observed house price inflation slowing, which has been a very welcome outcome. We've been more concerned about that with regard to our financial stability task than our actual monetary policy issues. But looking forward, demand pressures, particularly the net migration, is easing in our forecasts from around the net 60,000 permanent long-term we're observing at the moment down to about 30,000 over the period. And supply is coming on, both from private sector residential construction, but also through time around the Kiwi build. So we expect Kiwi build to be as big as it was, it's just happening later. That's the news between our last monetary policy statement and this, that they revised the timing around which they can get their activity done. On the other side of it as well is that, household debt levels are, very highly utilised. It's very hard to see how increased gearing from here will make enormous sense for households. And likewise, the bank lending behaviour has become a lot more cautious. So we're going to have to revisit, for example, our loan-to-value ratio targets based on this information. We haven't done that yet.
You sounded pretty sanguine about the international outlook, but we're seeing bellicosity on trade, Bernanke talking about Wile E. Coyote, concerns about emerging markets, the possibility of a no-deal Brexit and the Iran nuclear deal being turned up. How well placed is the bank to deal with a major negative shock when you're starting with an OCR, not of 8.25, but 1.75%?
Yeah, I would say we are well placed because the wonderful thing that New Zealand has is a floating exchange rate, and that would always be the number one first shock absorber from unanticipated global events, and we've seen that through history. I'm very pleased the way in which the exchange rate has been behaving over recent quarters. It's been remarkably close to any sense of fair value as we can estimate it, and so that type of pricing suggests some of the risks you're talking about aren't really sinking into business decision makers. The list of concerns you mentioned then, Brian, are always and everywhere, and I would imagine every other forecast period we've gone through time there has been equivalent lists of dark and scary things that we could point at. US economic growth has enormous considerable momentum. They are primarily a closed economy, so some of the trade restraints they're talking about don't have the same impact on the US as they might to economies like ours. That momentum is happening on the way through. Likewise, the Chinese, this is, by the way, we're using current knowledge. I mean, escalation would be escalation and we'd have to take that on board around tariff wars, but China themselves have kind of shifted their policy stance from one of restraining debt to one of becoming more accommodative to domestic spending, and that's why you're seeing, the 6.5% growth rate's being talked about now, not further slowing. So that's all there. Brexit, well, we're highly diversified as a trading nation. We will just have to ride those waves.
It's probably worth adding. So Adrian has talked a lot about how we might evaluate that information or as shocks happen. But in terms of being ready, of course we've got 175 basis points of immediate use and perhaps a little bit more. There is a bulletin article that outlines how we would think about alternative monetary policy instruments that other central banks have used. And New Zealand's also in a very fortunate position. It has lots of fiscal headroom should the need arise.
Governor, you've said that employment is roughly around its maximum sustainable level, yet we have 344,000 people who are underutilised according to Stats NZ, 12% underutilisation rate. Is this really as good as it gets?
We don't know, and I personally hope not. All we have is some reasonable historical estimates of a wide range of measures around something that we would call sustainable employment, and that's why we go at pains in our document to say here are the best range of indicators currently available to us to suggest what is this concept sustainable. Sustainable employment has of course its structural aspect and its cyclical aspect, and monetary policy mostly operates in the latter, in the cyclical aspect about making sure that growth is broadly around potential and inflation is stable, and hence employment and employers have their best opportunity to engage and be productive. On the structural side, there are big long-term questions that will have to be challenged and answered over time across all OECD countries. It's about what is the impact of technology on job demand, what are the skills that are needed for the future, what is the flexibility around employment hours and availability, what's the mobility capability, where are the jobs, what's the location. So there are big ongoing and forever structural issues, and we actually talk also in there identifying some of our challenging longer term unemployment, which is far too heavily weighted in Māori and Pacific Island unemployment. And again, a lot of that is around structural issues of location, skill, education, all of the challenges that need to be addressed. We collectively desire that unemployment equals zero, but that would be in a world where you've got, instantaneous trade of jobs and desires for jobs.
But the last time we got towards the end of our very long expansion, unemployment got below 4%, and the underutilisation rate, although it wasn't measured then, was 9%. Surely you can do more with monetary policy to get unemployment under 4%, which is the government's target.
Yeah, and that's why we have a very stimulatory level of interest rates right now. If we didn't believe it, we would be shifting much more quickly back to some sense of a neutral OCR. But we believe we have headroom both based on the inflation outlook, the core inflation, and also the uncertainties around this concept of maximum sustainable employment. So that's why we are saying lower for longer, balanced risks. We're certainly not ruling out the fact, and of course we're also forecasting the actual unemployment rate to decline through this forecast period.
So what is the current level of the neutral interest rate, do you think it is at the moment?
Well, you can kind of drive a bus through the estimates sideways. What's
About 3.5 is the point estimates. Yeah.
So 3.5% nominal interest rate, so we're south of that.
Just noting in your June OCR statement, you said the government projected spending impulse is also slightly lower and later than anticipated. And the key event, of course, between the June OCR statement and the May MPS was the budget. So I was just wondering, what is it that you saw within the budget that made you, or the spending impulse that you talked about, be lower and later than anticipated?
Primarily it was around the commencement of the Kiwi build. So we keyed our last forecasts off what they told us in December, their half-year economic update, and by the time they had got to their budget, they had been able to sharpen their pencils and fine-tune their planning, and at that point they had pushed out the main impetus of the Kiwi build by 1 to 2 quarters. Would that be correct?
Yeah, I mean, it's often uncertain about exactly when investment plans will turn into actual building, but we've been working closely with our colleagues in Treasury to try and fine-tune some of these estimates, and that was the information that we sort of learned.
And that estimate, was it only in the 2018-19 year, in terms of lower and later?
It's later. I think you need to get that idea. It's later, not lower.
Yeah.
It's just basically it takes time to buy the ute, get the shovels, find the concrete, convince someone that there's a paddock you're allowed to build on. I think that's probably how it works, isn't it? Oh, you need some water and electricity as well, apparently. And grey water. Capability.
Governor, are you saying that, did I understand you before to say that it was the dual mandate that gave you the scope to delay the forecast rate increase?
No. Well, actually, the dual mandate, yes. So yes is the answer, because that's what we're aiming at, the dual mandate. Where we have the most confidence at the moment around do we have headroom is actually on the inflation side. Core inflation has been remarkably low for a long period of time, and it is still below the midpoint of our target band. So while we have what I would say maximum employment in somewhere in this range of maximum sustainable employment, inflation is below. And so that is giving us the scope to continue to be expansionary in our monetary policy setting.
So core inflation was, I think, the highest in about 7 years on that sectoral factor model that you produce. I mean, where does it have to go to give you concerns about inflation pressures?
Core inflation, that is one measure. There are quite a few measures which we talk about in the document. For example, CPI ex food and oil, which is lower again. I think that's around 1.1. So, just as there's a range of measures for this maximum sustainable employment, there's a range of measures for core inflation. On balance, they are all south of the midpoint, and it is only very recent. The number you talked about, I think it's ticked up to 1.7%. which when I last looked is still south of 2, the midpoint. And when we are thinking hard about what are the broader inflation expectations and behaviours, there's still no real sign of that getting away from us. Can I remind people as well that we target a range between 1 to 3%. Of course you aim for 2 because that makes sense. If it's, it's no different if you were playing darts. If you're trying to hit the board, you'd probably best to aim for the middle. But it's the full range that we are targeting, and there will be noise coming through this. I don't want people to be spooked by that noise, by one-off price rises or near-term shocks. We have been most surprised by how low and stable global inflation and domestic inflation and inflation expectations have been.
I might just add, the short-term softening in the economy basically means that capacity pressure indicators are also a bit weaker or a bit more delayed. So the output gap, as we talk about it, is just a bit softer than we had before. So we just haven't seen the same prospect of a pickup in inflation, over the next short while as much. So that acceleration path's a bit softer than we had before, and hence, having a longer for lower rate track, keeping that stimulus there fits with that gradual acceleration that we're projecting.
Cool.
There have been arguments in the past for cutting the OCR because we've had such a long period where, as you say, it's been much lower for longer than anyone thought. How strong do you assess those arguments at this point?
We debate really, really hard about the up and the down. And the wonderful thing about debating is you can make incredibly convincing arguments about a cut, likewise about a rise. And so what we're trying to do is find that midpoint balance where we are best positioned for whatever next surprises us. We spent a lot of time thinking, well, with the genius of hindsight, if we could rewind time and go back 2 years, would have we had a lower interest? Did we miss something that everyone else could see? And I'm very comfortable on the answer is no. In fact, we have been the ones who have been continuously at the lower end or the lowest end of inflation expectations, inflation pressures. But what has happened in between? It's always the case of a whole series of unanticipated events. We've had an incredibly strong exchange rate for a while. We had incredibly low global inflation pressures coming through for a while. Our inflation expectations, we've had to change the way we even model and think about that. So there's been a whole series of types of lessons on the way through this. The good news is we've remained within the 1 to 3% range, even with this series of, I would say, asymmetric shocks keeping inflation down. Looking forward, what we have to do is recenter what we think these shocks could be. And so I can get myself equally spooked about near-term inflation, recent wage growth becoming widespread wage growth, putting pressure on margins, leading to price increases, leading to inflation increases and so on. That's one dynamic that we have debated hard here as to why might we be too sanguine about the current inflation outlook. Likewise on the growth, why aren't we cutting now in the face of very low business confidence and recent slow growth? So that's the balancing act that we've got going on here. So doing nothing is actually quite difficult.
Can you just expand a bit on your degree of confidence that economic growth will pick up in the rest of the year, and perhaps talk us through the scenario too, GDP growth remains below trend. As I see it, you've got a scenario where growth could stay at around 2.5% a year and the OCR will be cut 100 points. Is that correct?
Was it 100 in that scenario? Sorry, I can't. Yes, yep. So that is correct, yeah. And that's right. And we do this to try and give people a sense of a couple of things. One is that, these are the bounds of uncertainty we operate in. And two, that there is always time to do something about it with regard to monetary policy. So, it's quite interesting in modern day, our economics team are at the back there marking me on my answers. Some of them talk about those interest rate moves as being extreme, 100 down and then 100 up. That was almost a daily movement, when I was doing this role 10 years ago. So, well, not the governor role, but certainly sitting there trying to do economic forecasts. So, all of these things are within the realm of possibilities, but also within the realm of management inside of our inflation mandate on the way through. On the confidence, we are most confident by far around our central path, and that is based on all of the things we can observe today. The exchange rate, net exports, world growth, capacity constraints, and hence the need to invest, and government spending around the fiscal policy on a base of already high demand for residential construction and household spending. So I think we're just in a wonderful spot.
Sorry if I'm just asking you to repeat yourself, but if growth falls below 2.5%, you're cutting the OCR 100 points.
That was the scenario there. It is a modelled scenario. We'd have to ask why, how long, how persistent, etc. So do the same process, but that just gives you an indicator of the scale of those types of issues. If growth remained or actually slowed further below the potential growth rate, then we have more scope, more work to do with monetary policy, and that would mean we would have lower interest rates.
The Reserve Bank is doing a capital adequacy review at the moment, with the potential, of course we don't know, for increasing capital requirements for the big four banks. Have you taken that into account in your forecasts today for economic growth? Because in theory, if there were higher capital requirements, that might slow lending growth.
No, we haven't. We've just taken on the basis of current capital requirements and ratios, and you say in theory, I agree, in theory, in practice, who would know what it would actually mean for bank actual lending practice. What we've seen, and Jeff might want to elaborate, is that different capital levels tend not to have that bigger influence at all on lending. And you can see that cross-country globally through time.
And
and there's actually some evidence that higher capital ratios increase lending. I mean, the banks have got more capacity to lend, and they take advantage of it. And it's certainly been one of the factors that was a difference between the US and European pickups, is the change in capital standards and adequacy of those banks. So I don't think it's as clear as you're suggesting.
And Governor, what is your thinking on this, on whether the banks need to hold more capital at the moment, and whether that should be taken into account in your forecasts?
Yeah, I would say standing here as a governor of a central bank, more capital is always better, because that is a big buffer for economic shocks. And as Jeff has just mentioned, it doesn't necessarily impact on the efficiency of the banking sector per se. But I haven't predicted where we're going in that statement. I'm just saying in a perfect world. We go back through history, and I'll make it brief because I don't know much of it. Capital ratios used to be significantly higher than this magic number of 8%, which was really just a political agreement between Japan and the US back in the early 80s. There's nothing magical about 8%. It's just where it was when the photo was taken.
I'm just putting on your regulator hat for a second here. Has the Reserve... You need to actually get a real one that says regulator on it. That'd be hilarious. Has the Reserve Bank sought an independent review of Rabobank New Zealand's governance?
We don't comment on our regulatory activities with individual banks.
So do you have any comment at all about any concerns you may have with their governance at all?
No, I won't comment.
All right, another topic then. What's the latest with the FMA and Reserve Bank's review of bank and life insurance conduct and culture?
Yeah, well, it's in full swing, and I do want to congratulate the banks and our regulator colleagues as well. Actually, it has been it is still being a very well received and very open and transparent process that we're having with the banks. We've got a significant team of people on the ground. I think we've done 3 of the 4 major banks at this point. Actually, 2 to 3 weeks physically on the ground in the banks, talking from the board members, the senior executives, right through to branch salespeople and out in the regions. We're also speaking now with other vested interest folk, from consumer to complaints departments and whatever outside of the banks. So it's a thorough process. We hope to come back with our review mid-October, and it will be made public. And obviously, banks can choose to make as public as they want around their own individual results.
Governor, just on the reforms to the bank, I'm just wondering about your thoughts on the legislation now that it's been finalised, and when would you expect the new Monetary Policy Committee to start operating?
Yeah, good. Thank you, Matthew. And I still get surprised when people call me Governor. It's Adrian will do. I don't know the pub. For this legislation, I'd have to say it's very welcome. The team, and I've congratulated the team, and I will be doing publicly many times, haven't sat on their hands and waited for the legislation to arrive before we've started to think about what does this mean for us. So already we're well advanced around how would committee structures operate, the nature and type of people that we'd want to be involved, not that it's us employing them, and the whole decision-making process, and importantly this part of the process as well, about how we communicate. So I would say we're well on track to be in action as soon as the legislation is ready. We don't control that. I think early April they were hoping that it could be done. I would be surprised, I'd be disappointed if it isn't May next year, where we have our Monetary Policy Committee operating with our external members involved. The logistics have been surprisingly complex to work through once you start to think, wow, so how do we create the meeting, the decisions, the voting, the communication? So we'll make all of this available as soon as we can.
And just on the communication front, your statement of intent, you said very clearly that you want to improve communication and communicate to a wider audience.
Yep.
How specifically are you going to do that?
We're going to do on many fronts. The first one, you've got a very smart young man standing up just there behind you. Nara will probably look around looking for him, but I'm talking about Ngātarangi. We've got a communications team who is increasingly dedicated to digital, animated, all types of means of getting our stories out to people at their level of interest. And so we find that as very important. We've got a series of strategies going on. We're implementing a Te Ao Māori strategy. We will be speaking a lot more with iwi and Māori business, and getting into communities where increasingly they're becoming an economic powerhouse that we haven't had enough contact with, in my view. We've had significant, but I think we can get better insight across that. And we'll be working with FMA, with the financial capability. I'm sorry, Diana, she'll tell me off, I always get their name wrong. Teams across the board to try and assist and play our role in making what we do relevant and helping around that wider financial literacy.
What about your own engagement? I mean, I think you've been in the hot seat for a while now, but we haven't seen any public speeches. Is that on the horizon anywhere?
It is, and I have been speaking quite a bit, and shockingly to some of the ways we used to behave, unscripted. So that's happening. And yes, I intend. In fact, we're busy brewing up some excitement at the moment around how we talk about this bank as a whole and why it fits together, and how we've grown to be where we are, our role. Because I think if we can't explain our own story, then it's very hard to explain where we're going next. Did I miss anything there, Ngātarangi? Well, you've got the...
You mentioned the conduct review. Yesterday, ANZ announced that it was removing sales incentives for its frontline staff. Just generally, I know you're not allowed to comment on specifics, but what generally would you like to see the banks do around incentives and reducing the risks of mis-selling?
Yeah, I mean, welcome to the new world. There is regulatory minimum standards, and then there is public expectations. And it's the public expectations that drive business. If people try to operate business according to your minimum health or welfare or standard or whatever it is, then you probably aren't going to be a well-liked business. So what I really want banks to think about is their time horizon. It's as simple as that. Business has to be sustainable and repeatable through time. And so under or overlanding at different stages of a business cycle is not about looking through time. So if you can have whatever the incentive structures are over reasonable horizons related to indices beyond just near-term profitability, then you're probably well down the path to a far more sustainable business that will lift economic well-being and bring good returns home to the shareholder. So hopefully that knocked you all dead. Just before we will call us to an end, just before we leave, I do just want to note that the best dressed people in this room at the moment, from me looking out across here, are the young gentlemen sitting behind you, Bernard, the team there. They've come all the way from Tamaki Makaurau, Auckland Grammar, and I want to congratulate this group of fine future economists. They are our winners of the Reserve Bank's monetary policy competition for 2018. I won't tell you what they recommended for the OCR, but we're very, very proud of your efforts. It was a tough-fought competition, and congratulations for all your efforts. And I just do want to make one last bit. I just want to farewell, and I can't see him here, so I'll do it in his absence. It's even better. I'll wave to him on camera. Hi, Mike Hanna, our Head of Communications, who has been working here diligently, professionally, concisely, nicely, precisely for the last 13, unlucky for some years, has decided that he's going to step aside. He will remain with us at the bank, but in a role as the secretary to the board, so I'll continue to work with him. But I just want to publicly thank Mike for his wisdom and guidance over all of those years, and I know you all know Mike personally, so so he owes you a beer. Thank you. Thank you.